welcome back to another episode of Gee Wiz Weekends. I'm Emerald Fox.
I'm Lynette Zang.
Each week we're going to be pulling a social media post, and I'm going to be asking Lynette my questions that she's never seen before, and she'll be answering those questions with,
hopefully,
as much as she can. I'm sure she's going to have a lot of good answers for us. So without further ado, we'll dive right in.
Absolutely.
My post is from Stansberry Research, and they're highlighting the percent of stocks underperforming the S&P 500 for 2023. It looks like about 70%, which you'll be able to see on your screen. That seems pretty scary, 70%. Does this show we can expect something crazy to happen in the markets coming up soon? Or is this, something that regularly happens?
Well, look, these kinds of things happen in a managed market. Let's face it, between the Federal Reserve and the government, there are entities that have been chosen to succeed, right? And others that don't matter that much. What that is really showing you is that most of the market gains that we've seen over the last number of years have been based upon liquidity and what's called herding. In other words, we have these top 10 stocks like Amazon, especially in the technology sector, Apple, Amazon, Microsoft, et cetera, that all of these mutual funds and ETFs, and there's tons and tons of new ETFs that have all piled into the same few stocks. So when you're looking at the S&P or any of those, and you're in the NASDAQ especially, but you see them going up, that's hiding most of the stocks, a lion's share of the stocks that are seriously underperforming. But if all you're looking at is, the market went up today or the market went down, which we'll talk about in a second, right? What you're really looking at more than anything else is the result of herding.
Okay.
That works great on the way up because a lot of these stocks, they are borrowed. The money is borrowed to buy them. So the higher they go, then there's more room for equity. And these companies, these ginormous companies, can borrow more based upon that stock going up.
Okay.
But it also works in the reverse. Okay. So when we see them take a leg down, right, that's going to impact all of those mutual funds, all of those ETFs, and all of the individual stocks, because now when the stock market goes down, these companies are getting what's called margin calls, which is they borrowed to buy these stocks. Now they have to be, the equity in there has to be at a certain level. And when the stocks decline, that equity erodes. And they have to come up with more money for the margin. Correct.
Wow.
If they can't, then those shares will be sold, or something, whatever the market's going to bear, will be sold off, which is why frequently when you see a market implosion, you'll see spot gold decline. It's because they've got to sell these shares. That's what the market is willing to buy in order to meet that margin call. And ultimately what that does is it creates a doom loop. And some say a righteous doom loop, right? So the way that it works is, it's the doom loop on the way up. Okay, the shares rise in market value. They can borrow more against it. And so that pushes, they're buying more of those shares. That pushes the stock price higher, et cetera, et cetera. Right. See that loop?
Yeah.
But on the reverse, now the shares are imploding. They've got to come up with money. They got to sell whatever the market's going to buy, right? And so if they can't do that, then the funds are forced, or the exchanges rather, are forced to sell off those shares, which pushes the price down more, which erodes that equity more, and they have to come up with more money, more margin money to keep that going. And that's why it's called a doom loop.
Just a continuous effect of awful shares and meeting the margin call at the end. So,
exactly.
Wow.
But a big part of the problem is that those same shares are held in almost all of the ETFs and all of the mutual funds. So what happens to one happens to another, right? And that just makes that doom loop grow bigger and bigger and bigger. They want us to believe that diversification are stocks and bonds. Right. And hey, mutual funds, ETFs, boy, that's real diversification. But it's not, because they're all fiat money assets, right? And so they all will go the way of the dollar, which we know the real trend is down. And you, everybody that's watching this should know that too, because inflation is telling you the value of the dollar, the purchasing power of the value of the dollar is declining.
Right.
So you need to have some gold and some silver physical in your possession. So if you have those intangibles, now you got those tangible assets. So when these go down, these go up. Yes.
Awesome. All right, so that leads me to my next question. Even though the top 30% of the companies or less held the S&P 500 and even allowed it to break record highs, is it a record high or is it just inflation?
That is such a good question, because what you're really talking about is nominal confusion, where people marry the numbers, and it also hides the true trend. The real trend, you talked about stock markets making new highs. Well, interest rates are a key tool that central bankers use to regulate the rate and speed of inflation. Who has access to that money at 0% interest are these large corporations and Wall Street entities, right? So they can borrow the money to push up the prices and make it look like that. However, to your point, you can only convert those stock market gains into dollars, in this country, dollars, or the local currency, wherever you are. And the real trend is what's happening in the purchasing power. And what do we know? Inflation, even if you don't ever look at a chart, inflation, if you go to the store and it costs you more to buy the same goods and services, that's really the erosion of the dollar. So today we have $1 trillion companies. But guess what? In Venezuela, in 2012, 13, 14, and 15, I could be off on my dates a little bit, but it's in that range. Venezuela had the best performing stock markets in the world. But they were also going through hyperinflation, which has not been resolved yet, because they don't change behavior. They just change the way they account for it. And so if all you can do is convert these assets, like stock market assets, into the fiat money, well, guess what? 1 trillion times zero is still zero.
Right.
And what do we know? We know that no fiat money, so no government-based money, has ever survived the test of time. And this is why it is so critically important to be well diversified. Now, of course, Wall Street wants you to think that diversification is in stocks or bonds. And hey, you can get a lot of diversification in mutual funds or ETFs. But the reality is it's all just in one thing. That's the fiat money product, right? With lots of debt and leverage built into it by design to make it look like it's going up, to your point. But in reality, you need to be properly diversified. All that stuff is intangible. You can't hold it. It's held inside of the system. And of course, it makes it easier for them to steal your wealth from you, especially if you think it's going up, when in reality it's going down. But this is why you have to have physical gold in your possession, because that's truly diversified. Right now you have gold and silver that are severely undervalued. You've got stocks and bonds and real estate and those fiat money, those targeted for reflation by the central banks at nosebleed levels. That's going to flip-flop. So you've got to have particularly gold for wealth preservation, so that when that happens, when those stock markets decline, either because they do the overnight revaluation or the money's just not coming into them, so they implode from their own weight because they're so overvalued, meaning the stocks.
Right.
Okay, this is proper diversification, not fiat to fiat, but intangible to tangible. Does that make sense?
Awesome. Yes, that was such a great explanation. I love it. Thank you.
Good, you're welcome.
Now, I do have a question for you from one of our viewers. They emailed us at questions at LynetteZang.com. And this viewer is Doug P. He said, you have explained the danger of bank bail-ins.
Yes.
But does that apply to credit unions, which are not corporations, but are member owned?
Well, that would be accurate because whether it's a credit union or a small global or a small local community bank or any of them, unfortunately, they are dependent on the big commercial banks. So the Wells Fargos, the JP Morgans, the Bank of Americas. There isn't anybody that's really going to be immune. What's good about them is they don't do these big bets, right? The derivatives, which the large banks do. But when the system implodes, if you look at what happened in 2008, well, the big banks got a lot bigger because they absorbed all of the smaller entities. So there is no hiding in a credit union because the credit unions are still dependent on the big banks.
Right.
And they're still holding your fiat. So, I mean, we have to have these entities in order to barter, right? Pay our bills and things like that.
Right.
But personally, I don't hold more than I absolutely need to inside of the banking system. I'll hold cash outside of the banking system. And then if I need to, I mean, I hold what I need to because I'm running a business, right?
Right.
But beyond that, I'll hold the level of cash outside of the system because I can always make a deposit. But I think what everybody's going to find out when it comes to bail-ins, that you can't always make a withdrawal.
Right. Well, as always, I'd love to thank you, Lynette, for your invaluable knowledge. We really appreciate it. I know all of us do.
It's my pleasure. I'm here to be of service.
And if you would like Lynette to answer your question, please reach out to us at questions@LynetteZang.com. We are having a wide influx of questions right now. So we're going to be actually starting a podcast where I will be asking Lynette your questions. So if you want to be included in that, then please send us an email so that we can get those questions answered.
Yep.
And that's it for today's Gee Wiz Weekends.
Yes, I do. Okay. I want to remind everybody to help us grow this channel, right? And the best way that you can do it is to give us a thumbs up, leave us a comment, even if it is just hello or thumbs up. And I know people have done that, which has been fabulous. And share, because ignorance doesn't make anybody immune. It just leaves everybody vulnerable, like we were talking about today. So subscribe, hit that bell. We'll let you know when we're posting another hopefully great video. And until next we meet,
stay safe out there.
Bye-bye.
Bye now.